Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Gen Digital Inc. quarterly report. Gen Digital Inc. offers a wide range of cyber safety solutions for various entities. The company provides security and performance management services, identity protection, and online privacy solutions to individuals, families, and small businesses. Its technology platform encompasses several key areas. The company operates under multiple brands, including Norton, Avast, LifeLock, MoneyLion, Avira, AVG, and CCleaner. These brands cater to different needs and provide a comprehensive suite of services for users. With its extensive range of products and services, Gen Digital Inc. has established itself as a leading provider in the cyber safety industry. Gen Digital Inc.'s history dates back to 1982, when it was founded under a different name. The company underwent a rebranding exercise in November 2022, changing its name to Gen Digital Inc. Today, it is headquartered in Tempe, Arizona, and continues to innovate and expand its offerings in the cyber safety space. The stock price of Gen Digital Inc. has dropped significantly over the past year, exceeding minus 12.24%. Several factors have contributed to this underperformance. One major reason is the broader technology sector challenges, including concerns over AI competition and cloud growth deceleration. This trend was exacerbated by mixed results from major tech companies, leading to a sell-off in software stocks. Additionally, economic uncertainties have affected tech stocks, causing investors to navigate shifting market dynamics. Gen Digital's stock has underperformed compared to the Nasdaq Composite, dropping 7.9% over the past year, while the Nasdaq gained 14.6%. The company's execution challenges and market volatility have also contributed to its decline, with the stock trading below its 200-day moving average since early October 2025. Despite some positive financial news, including beating revenue and EPS expectations in November 2025 and reporting strong fiscal third-quarter results in February 2026, these developments did not prevent the overall significant decline in the stock price. The company's stock has reached new 52-week lows, indicating a prolonged period of bearish sentiment. Gen Digital Inc. market capitalization of $15 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Gen Digital Inc. holds a significant advantage in their industry. Gen Digital Inc. trades at a higher price-to-earnings ratio of 25 times and a higher price-to-book ratio of 6.35 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.06%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. Market demand and competition play a significant role in determining revenue, as changes in market conditions can impact sales. Regulatory changes in compliance also have a substantial effect on revenue, with non-compliance resulting in penalties and fines. Customer satisfaction and retention are crucial for sustained revenue growth, while economic conditions and macroeconomic factors such as inflation, currency fluctuations, and consumer spending levels can significantly impact revenue. Industry-specific drivers like technology and innovation, partnerships and collaborations, and intellectual property and licensing also contribute to revenue growth or decline. Risk factors such as data breaches, regulatory penalties, and intellectual property disputes can lead to revenue decline. Seasonality and macroeconomic conditions, including interest rates and global economic trends, can also affect revenue. Understanding these drivers is essential for businesses to make informed decisions and adapt to changing market conditions. Net income experienced a significant fluctuation between 2024 and 2026. In the fourth quarter of 2025, net income decreased by 20% compared to the same period in 2024, dropping from $501 million to $192 million. However, when comparing the first quarter of 2026 to the previous quarter, there was a notable increase of 21%. The 9-month period ending January 2, 2026, saw a net income of $461 million, down from $501 million in December 2024. Profit margins also underwent changes during this time. Gross profit margin decreased by 1.3 percentage points on a quarterly basis, but increased by 2.7 percentage points year-over-year. Operating income margin showed an increase of 15.6 percentage points on a quarterly basis, but a decrease of 4.5 percentage points year-over-year. The reasons behind these changes are multifaceted. Net income decreased due to higher financing costs, resulting from adverse macroeconomic conditions and government efforts to combat inflation. Additionally, potential losses from hedging or other mitigation actions to mitigate against interest rate exposure contributed to the decline in net income. Increased tax expenses from changes in effective tax rates also played a role. Profit margins declined due to increased costs and working capital requirements. The dilution of stock ownership of existing shareholders and ongoing contractual obligations also negatively impacted profit margins. Furthermore, unanticipated delays or failure to meet contractual obligations added to the decline in profit margins. The company's financial performance indicates a positive trend in its operating cash flow. For the 9 months ended January 2, 2026, the company generated an operating cash flow of $1,066 million, demonstrating a significant increase from the previous year. In comparison to the same period in 2024, where the operating cash flow was $748 million, it is clear that the company has made substantial progress in generating positive operating cash flow. This improvement suggests that the company's operations are becoming more efficient and profitable, which is a positive sign for its financial health. The company's debt level has remained relatively stable over the past few years. However, there have been some notable changes in interest expenses. Specifically, on page 34, it is mentioned that interest expense decreased by $3 million for both the 3 months and 9 months ended January 2, 2026 compared to the same periods in 2024. Similarly, on page 37, a decrease of $4 million in interest expense is noted for both the 3 months and 9 months ended January 2, 2026. These decreases indicate that the company has managed to reduce its interest expenses over time, which could be a positive sign for its financial health. Management's strategy for the company is centered around delivering innovative technology solutions through its cyber safety platform and trust-based solutions, which provide superior threat protection, identity management, reputation protection, and financial wellness. The company has a strong foundation of trust and innovation that enables it to deliver confidence and protection in a digital-first world. The company's capital allocation strategy balances driving shareholder returns with managing financial risk and preserving flexibility for strategic options. However, the international growth of the company will increase exposure to foreign currency fluctuations and volatile market conditions, prompting management to reassess its approach to managing these risks. To stay competitive, the company must continually develop new and enhanced solutions that meet customer expectations and stay ahead of competitors. This requires a focus on innovation and product development. Additionally, the regulatory environment is highly uncertain and may subject the company to adverse effects on its business due to changes in laws, regulations, and enforcement priorities. Management is confident in the long-term overall health of the business and the strength of its product offerings. However, they acknowledge that adverse macroeconomic conditions and government efforts to combat inflation will lead to higher financing costs and negatively impact the consumer finance industry. The company has made several significant acquisitions and divestitures over the years, shaping its business landscape. Acquisitions have been a key part of the company's growth strategy. Notable acquisitions include MoneyLion, Avast, and Avira. The acquisition of Avast in September 2022 marked a major milestone for the company, expanding its cybersecurity capabilities. Additionally, the acquisition of Avira in January 2021 further strengthened its position in the market. The company has also made strategic divestitures to focus on core areas of business. In November 2019, it sold Symantec endpoint protection products to Broadcom, marking a significant shift in its product portfolio. The sale of enterprise security assets to Broadcom Inc. in 2019 was another notable divestiture, allowing the company to concentrate on high-growth areas. Furthermore, the company has wound down JumpShot, a data collection service provided by Avast, and terminated its provision of data to JumpShot in January 2020. This move reflects the company's commitment to prioritizing user privacy and security. In summary, the company's acquisitions and divestitures have been instrumental in shaping its business strategy and focus areas. By acquiring key assets and divesting non-core businesses, the company has positioned itself for long-term growth and success. The company has demonstrated its commitment to returning value to shareholders through various means. On the dividend front, it is clear that the company has paid dividends in recent years. Specifically, in 2024, the company paid out $236 million in dividends, and this was not an isolated incident, as quarterly dividends have been a regular occurrence. Furthermore, the company has also made significant investments in share buybacks. In 2024 alone, the company repurchased common stock worth $434 million, building on the $272 million spent on share buybacks in 2023. This indicates that the company is actively working to reduce its outstanding shares and increase shareholder value. In conclusion, based on the available data, it is evident that the company has paid dividends and bought back shares as part of its efforts to reward shareholders and enhance their returns. Their concerns about inventory buildup and supply chain disruption are warranted. There are valid concerns regarding inventory management and potential supply chain disruptions. One such concern is the buildup of digital assets held by companies like Zero Hash, which could lead to inventory issues. Furthermore, there are also concerns about supply chain disruption due to changes in the retail landscape. The consolidation of electronics retailers has increased their negotiating power, allowing them to dictate terms to suppliers. This shift is further exacerbated by the decline of physical retailers, reducing channels of distribution and making it more difficult for products to reach consumers. Additionally, online sales are becoming increasingly consolidated, which reduces the number of channels available for online distribution. These changes have the potential to disrupt supply chains and impact businesses that rely on them. That concludes the financial summary for Gen Digital Inc. Feel free to comment below, and I will be happy to answer them when possible.